Paul Donovan at UBS has discussed the role that corporate profiteering plays in persistent inflation. While inflation has fallen from 9%, as you know, it has peaked to 4%, prices continue to climb because of supply shortages and corporate profiteering, what we're starting to call greedflation. Given that rising interest rates certainly won't solve greedflation, why maintain interest rates at the current level or even consider, as you suggested, raising them again, given the risk of harming the livelihoods of more than 1.5 million workers and their families?
Mr. Chairman, the committee broadly feels that while monetary policy has gotten to an appropriately restrictive level, if the economy performs about as expected, that it will be appropriate to raise hikes again this year and perhaps twice. A strong majority of the committee feels that it will be appropriate again, assuming that the economy performs as expected 2 times before the end of this year. We've come very far, and the reason why we maintained our rate at the last meeting was to give ourselves more time to stretch out the time for making these decisions. We moved very quickly at the beginning, and we've gradually slowed down. This is just a continuation of that. But we are committed to getting inflation under control, and the strong majority of the committee feels that we're close, but there's a little further to go with rate hikes.
Well, thank you for that answer, but Mr. Chair, what Fed governors call cooling down, regular people where I live call them layoffs. The question is, why should working families continue to bear the cost of fighting inflation? Why should they lose their jobs so that corporate profits can continue to balloon? Let me move to the next question. Our economy's created 13 million new jobs in the last 2.5 years. Black and Latino workers with the lowest incomes have seen the greatest gains in job opportunity and wage growth. What the Fed considers too hot an economy has given these workers their first leg up in decades, if ever. We know that job losses will hurt those same workers the most. How will higher interest rates and the resulting job losses disproportionately impact Black and Latino and low-income workers?
Well, we have quite an unusual situation in the labor market where we've had persistently much higher demand for workers than the available supply of workers. So some of the process of getting demand and supply back into alignment has been taking place through declining job openings and through lower quits rates and through wages that are moving, that are still very high, but moving into more sustainable levels of increase. So actually there hasn't been a meaningful increase in unemployment. The unemployment rate has bounced around at historically low levels, and that's fine. That would be the perfect way for this to continue to happen. There's no guarantee that will happen. I would just say that it is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
And thank you. But the dual mandate suggests that those workers, that obviously you look out for those jobs and those workers, but we also know that those workers are the first to be laid off. And I would hope that in your next meeting, the Fed recognizes those disparities and gives them real weight as you make decisions that will likely at some point result in more layoffs. Probably my last question. Since you last testified in front of this committee, we've had 3 of the largest bank failures in U.S. history. You explored that a bit at the end of your testimony because the executives at those banks failed at Banking 101. Regulators took swift and decisive actions to protect the banking system and depositors. Thank you for that. That's in stark contrast to regulators' supervisory failures in the years before the 2008 financial crisis. What actions are you taking today to prevent more bank failures and to make sure banks do real risk management and address liquidity and other basic risks? And you may in part want to answer, he can do it himself, but Ranking Member Scott's comments on Vice Chair Barr and where that takes us. But what do you do to make sure banks do real risk management and address liquidity and other basic risks?
So I would say we are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other 2 failures and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size. And I can go into more specifics in the course of the hearing, but I do think we need to learn those lessons, and I think we've started to do that. And it's something, what we saw was an unexpected bank failure overnight led to contagion and threatened the broader banking system, and that's not supposed to happen. And we're gonna take appropriate measures to reduce the chances that something like that would happen.
Let me follow up briefly on that. The Fed plans to propose an overhauls we've talked about to existing bank capital requirements, so we have a more resilient banking sector. Is increasing capital requirements for banks with $100 billion or more in assets to prevent future bank failures, is that a strategy the Fed plans to, is willing to deploy to promote financial stability?
So we have not come to there hasn't been a final proposal. There's been a proposal that's been circulated, but it's, in my understanding, it's not final, and I know things are still moving around a little bit. So I don't really have a final proposal that I can comment on. I do think that the capital increases that are getting so much notice are really on the larger banks. There may be also some capital increases in the proposal for banks down to $100 billion, but not below that.
And yesterday you said we want to, in particular, the G-SIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. You stand by that statement?
I did, and I said, of course, we did spend years raising capital and liquidity standards a great deal on those institutions, and I supported all of that. And then I concluded by saying that further increases, if they are proposed, will need to be justified. They'll, of course, as any change in rule would be.
Senator Scott.
Chairman, let's stay